Hi, I'm Daryl Jones, Director of Research at Hedgehog. I'm here with Jay Van Sciver, who's our industrial sector head. Jay and his team are doing a black book call on the agriculture sector on Friday. We just wanted to do a little preview of that call. So I guess, the first question is just around, why Deere, AGCO, CNH now? You've done a lot of work on CAT in the past. Why shift to these companies right now?
Yeah, CAT and Deere are often put in the same category in machinery. And the way we think about that group is within the context of resources-related capital equipment used to produce commodities. And what we've seen, very much in the last, 10, 12 years was a boom in commodity prices, whether it be agricultural commodities, energy-related commodities, oil being most notable. Copper is one that we would also, I think, have spent a lot of time on. You would expect sort of the largest copper price change of the last century to be the transition from the Great Depression to World War II, but actually it was really the Bernanke Fed and the fixed asset investment bubble in China.
Yeah.
And what's interesting, you would have expected a similar dynamic in, for example, corn prices, but the largest increase in real corn price we've seen was actually over a 10-year period, was actually pretty recently. And when you get a big spike up in commodity prices, you tend to see a big spike up in the capital investment to produce those commodities.
So I guess you sort of hit on this, but how do you think about normalized demand in the industry given kind of that backdrop? And what do you think investors are probably misreading right now?
So if you look at unit sales within the context of farm equipment, what really matters to companies like Deere and AGCO and CNH is large, high horsepower tractors, self-propelled combines. Those are where the high margins really are. And if you look at I think investors are looking at unit sales very often and unit ages. And what you've seen is actually a 50% improvement in productivity of that equipment over, say, the last decade, or at least that's what the manufacturers will tell you. But it's a lot more efficient. And when you if you look at unit sales, they are elevated, but they're actually vastly more elevated in terms of their capacity to produce these commodities.
Gotcha.
And that, I think, is an overhang that people are underestimating.
Yep, totally makes sense. So what do you think this means for Deere AGCO's management strategy? And is there anything that they can do to sort of, offset what really is too much capacity, for lack of a better word?
So there's only a limited ability of a management team to, they can either they could sell the whole company. So some cyclical managers did manage to do that. Bucyrus sold at the peak. JLG, aerial work platform, sold pretty close to a peak. But for the most part, if you're Deere, you're not selling the whole franchise to somebody. And there's a limited scope of a manufacturer to sort of create their own demand. The demand is the more cyclical part of a manufacturing company in these kinds of an industry. So, for example, in 2012, you couldn't not sell mining equipment. It was very easy to sell a mining truck. Today, there's nobody buying mining equipment. It doesn't matter how clever your levitating, mining truck is, it's not going to sell. And in the same dynamic, you saw agricultural equipment sell quite easily. Prices were reasonably strong through the ag boom. And as we head into, the next few years, I think it'll be very hard to move mining equipment.
So you're the investor now. What does this mean for your strategy? How do you think about positioning yourself?
So I think that's something we'll really hit on in the slide deck. Yep. But I think there is going to be a lot more volatility as we look out in the ag space into 2015. Particularly the current hedging environment over the next year or two is very different than we've seen in previous years. And that's really, combined with some excess used equipment in the inventory, in the channel, sets up a situation where the rubber will really meet the road, and it's very important to be positioned well.
Okay, great. Well, once again, I'm here with Jay Van Sciver, our industrial sector head. Jay and his team are going to do a deep dive on Friday into the agriculture sector, and I think there's going to be a lot of ways to play it this year given the volatility that you expect. So hopefully everybody can dial in. Thanks.